At ease, recruits. My name is Yaroslav, and I'm going to be your instructor today about the Forex markets. What is Forex? How do we trade it on our Olymp trade platform? And what else can you teach us today, Yaroslav? Well, Forex, the foreign exchange market, is the biggest financial market in the entire world. Basically, we as retail traders are small fish in a very big pond. Countries around the world have different currencies, and there is a mechanism that makes it easy to trade between the two currencies in large amounts very quickly and effectively. That is Forex in a nutshell. Now you know. The biggest participants in the FX markets are banks. There are many, many different kind of banks. They're large and small, and the largest banks are the transnational banks and the government central banks. These are large banks and are major participants who run about 90% of the volume on the Forex market. All these participants link together over an electronic communications network or ECN. Now, the Forex market, like I said, is the biggest market around the whole world. This chart is from 2013. It compares with the next in line biggest exchanges. The New York Stock Exchange and the Shanghai Stock Exchange don't even come close. Now, just so you know, right now in 2018, the daily volume is about $7 trillion, and until 2020, the World Bank makes a prediction that it'll be around $10 trillion in one day. So there you go. Lots of opportunities in this market. Now, as you already might know, currency is traded in pairs. So basically, we have one side and then we have another side. Now, the major pairs that they are included with the dollar, and there's a term called their major pairs, so major currency. And they have a leading share in most of the turnover daily in the Forex markets. So we have the euro dollar, which is the European currency in the Eurozone with the United States dollar. Have the pound dollar, dollar franc, dollar yen. As you can see, I'm going to use these abbreviations or these terms, and we'll go over them a little bit later. But basically, the first two letters that you see, let's take a USD CHF. US is United States, D is dollar, and CH is the Switzerland, F is franc. Same thing goes for JPY, Japanese yen, CAD, Canadian dollar, and so on. Now, there are cross combinations of the major currencies, and these are called cross pairs. They include one major currency with another and don't have to include the US dollar. Now, you can construct them by yourself, but I'll give you examples of the euro crosses. We have the euro pound, euro franc, euro CAD, euro Aussie, and euro New Zealand dollar. Now, we also have another category. Over the years, there have been strong economies emerging from emerging markets. Now, the trading turnover is still small, but it's rising, and there has been more and more demand for these currencies. So now we have the opportunity to trade things like the Hong Kong dollar, the Singapore dollar, the Russian ruble, the Chinese yuan, and so on and so forth. So if these currencies are available to you or not will mostly depend on your broker. Not everybody provides the possibility to trade these pairs, but I'm not really sure that you want to trade all of them because some of them are very unpredictable and volatile. Now, for the Forex market, basically these are the top currencies currently in circulation: the United States dollar, the Eurozone euro, pound, Switzerland franc. Here in the middle column, we have the name of the currency, and here's the nickname. You may have heard me use a few of these nicknames, but here we have the dollar is the buck, the euro is the fiber, the pound is the cable, and so on. New Zealand dollar is called the kiwi. Now, a way for you to understand when we get later into graphs, how does it work? Like when the graph is going down, what does that even mean? It might be hard for some people to even understand. I use this example of a seesaw. So imagine the euro on one side and the dollar on the other. If one overweighs the other, it drags the seesaw on its side. Basically, it has grown. It has increased in value. It has become more juicy, and that's why it drags it down. Okay, so when the dollar overweighs, and the graph goes up, that means the dollar is rising in price. Now, if in this case of the euro dollar, actually, the way that it's positioned, if the dollar is heavier, the price will go down. You see how that happens? So in the currency pair euro dollar, if the dollar is stronger, the graph goes down, right? And that means the euro is losing in value compared to the dollar. So this example of the seesaw, it makes it easier for you to understand the picture. Now, how do you trade this market? Basically, it's the biggest market in the world. What are some of the tools that I have? Now, one of the golden tools that are available to us is leverage. It is the most important tool. This is the one thing that allows us to extract sizable amounts of profit from this market, because the difference, the amount that changes every time is very, very small. During the day, I mean, we'll be lucky if the price fluctuates 1%, 1.5%. And to be honest with you, it's very rare to find that the euro moves in one day more than 2%. Well, how do we extract profit? How do we speculate on that if it moves so slowly? Well, that's where leverage comes in. Basically, leverage is provided by your broker, and they give you extra money to trade. They credit your account so that you can open positions much, much more than what you already have. Like, let's take the example of leverage 1 to 100. Now, you can open a position 100 times more than the money with the money that you have in your account. An example would be, let's say you have $1,000 on your trading account. With leverage of 1 to 100, you can open up a position with a lot size, 100,000 worth of dollars. Isn't that great? A move of 1 penny in the euro dollar pair from say 115 to 116, if you bought, will result in a profit of $847.46. It's not a bad profit for a 1 penny move. Now, you heard me mention the word lot. What is a lot size? Basically, a lot is a standardized amount of currency in one contract. Now, the size is usually 100,000 units of base currency. Base currency is the first part of the equation. So euro dollar, euro is the base currency, dollar is what we use to pay for it. Pound dollar, pound is the base currency, euro is what we use to pay for it. When you trade with most brokers, you can actually change the amount of lot size by fractions. So you can buy 100 lots, or you can buy zero point 0.1 of a lot. So that makes trading with small amounts actually really easy. Now, what kind of commissions are usually included in trading the Forex market? Well, there's the spread. That's the difference between the buy and sell price. Usually you can see it on your graph. If not, you actually get the bid and ask. That's what that is. The bid and ask, with that little area in between, that's what the broker makes. That's his commission. If you open and close a position instantly, uh, you will incur a loss of only the spread amount. So keep that in mind. Now, there is a financial exchange trade type. It's called a swap. It usually happens between banks, and that's when the counterparties exchange different currencies for a defined amount of time, and then they give the currency back to each other with interest. Now, I don't want to confuse you, so that's one way of swap, but the one that usually is that you encounter in retail trading is rollover swap. So please don't get the two confused. A rollover swap is the value of overnight interest rates on the currencies that you have paired. So, for example, if you buy a currency with a high interest rate and you get sold another currency with a lower interest rate, the swap that you pay overnight will be the difference between the two. So say you borrow where there's a higher interest rate, or sorry, you buy something with a lower interest rate and you let borrow with a higher interest rate, the difference will be a positive swap for you because your currency has a higher interest rate, and vice versa. Now, the differences in Olymp trade from other retail Forex brokers, there is no standard lot size. Basically, you can say right away how much money you want to bet, and you get to increase the multiplier. The multiplier basically works like leverage in your favor or against you if the price goes the other way. Uh, Also, in the Forex market, you can have negative or positive overnight swaps. Um, but because you only trade on the difference of currency values on the platform, positive swaps are not incurred. But that's okay because there's a positive side. Usually the opposite side of a trade is taken by another trader, and there's lots of slippage and uh, lots of ways that you can miss a trade. That doesn't happen with Olymp trade, and the counterparty is the broker. And in the spot forex market, you can deposit local currency into the account, say rubles, if you live in Russia. And when you place an order to buy euro dollars, first the money gets converted into dollars, and then you buy euros with the dollar, and you carry an additional risk of currency devaluation or at least fluctuation, which may take some percentage points off your bottom line. Now, that's it for the Forex market. We'll go over fundamental analysis and technical analysis in the next lesson, and we'll start to work with graphs, and you'll have a better understanding of how it looks visually. But for now, thank you so much for your time. I hope you enjoyed the video. Good luck trading out there.